Imagine waking up tomorrow and seeing gasoline at $7 a gallon. Airline tickets suddenly double. Food prices surge. Stock markets panic. Central banks begin emergency meetings. And the cause of it all is not a war, not a recession, but a 21-mile stretch of water between Iran and Oman, a place where nearly one-fifth of the world's oil supply moves every single day. This narrow corridor is called the Strait of Hormuz, and despite its small size, it may be the most economically important shipping route on Earth. Every day, enormous oil tankers, some longer than 4 football fields, move slowly through these waters carrying millions of barrels of crude oil toward refineries across the globe. That oil becomes gasoline in Japan, jet fuel in South Korea, and petrochemicals in Netherlands. In other words, much of the modern global economy literally flows through this one narrow corridor, which raises an uncomfortable question. What happens if that corridor suddenly becomes unsafe? Not closed, not destroyed, just uncertain. Because in global energy markets, uncertainty alone can move prices. Every day, roughly 20 million barrels of oil pass through the Strait of Hormuz. According to the U.S. Energy Information Administration, that represents roughly 20% of the oil traded globally. Most of this oil comes from countries along the Persian Gulf, Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates. For these producers, the Strait of Hormuz is essentially the main exit route to global markets. And that's where the vulnerability begins. Because the global energy system is often described as a complex network, but in reality, parts of it behave more like a funnel. Oil from the Gulf flows through pipelines to coastal terminals. From there it is loaded onto tankers, and many of those tankers must pass through this single choke point before reaching open ocean. There are a few alternative routes. Saudi Arabia operates pipelines across the peninsula to ports on the Red Sea. The UAE has a pipeline to the Gulf of Oman. But even combined, these alternatives can only handle a fraction of the normal volume. In other words, if something disrupts the Strait of Hormuz, a large portion of the world's oil supply has nowhere else to go. When people imagine a disruption to global oil supply, they usually picture a dramatic scenario, a naval battle, a blockade, tankers being stopped at gunpoint. But the more realistic scenario is far quieter. The Strait of Hormuz does not need to be closed to create an economic crisis. It only needs to become dangerous enough that shipping companies hesitate. Oil tankers operate on tight margins and strict safety calculations. If the perceived risk of sailing through a region rises, insurers quickly respond. The largest marine insurers, many operating through the historic market of Lloyd's of London, can begin adding war risk premiums to vessels traveling through conflict zones. Those premiums can rise extremely quickly. During the so-called tanker wars of the 1980s, when shipping in the Persian Gulf came under threat, insurance costs surged dramatically in a matter of weeks. And those costs do not stay with the insurer. They move through the entire supply chain, from tanker operators, to oil traders, to refineries, to gas stations, and eventually to consumers, all without a single shipping lane actually closing. Another factor that makes this choke point uniquely vulnerable is the nature of modern naval warfare. In the confined waters of the Persian Gulf, relatively small and inexpensive weapons can create enormous disruption. One of the most effective is the naval mine. According to various defense assessments, Iran possesses a large inventory of naval mines designed specifically for use in narrow waterways. These devices are not particularly advanced. Many are simple contact mines, floating explosives that detonate when a ship strikes them. But their impact is psychological as much as physical. If even a handful of mines appear in shipping lanes, tanker captains will hesitate. Insurance companies will raise premiums. Some shipping companies may temporarily suspend operations entirely. Clearing mines takes time, and during that time, global oil markets react immediately. Prices move not just on actual supply disruptions, but on the expectation of disruption. If oil suddenly jumps to $150 per barrel, the effects would reach far beyond energy markets. Oil is not just another commodity. It is a foundational input for modern economies. Transportation depends on it. Agriculture depends on it. Manufacturing depends on it. Even plastics and synthetic materials are derived from petrochemicals. When oil prices surge, the cost of almost everything begins to rise. Fuel for trucks becomes more expensive. Shipping costs increase. Airlines raise ticket prices. Farmers pay more for diesel and fertilizer. The result is a wave of inflation spreading across the entire economy. Economists have a term for the worst version of this scenario: stagflation. Stagflation occurs when inflation rises while economic growth slows or stops. It is one of the most difficult economic conditions for policymakers to manage. The world has experienced this before. In the 1970s, geopolitical tensions in the Middle East triggered a series of oil shocks that sent global prices soaring. At the time, the United States faced a painful combination of rising inflation and slowing economic growth. Unemployment increased, prices climbed, and policymakers struggled to respond. Central banks normally fight inflation by raising interest rates, but higher rates also slow economic growth. In the 1970s, breaking the inflation cycle required extremely aggressive interest rate increases that pushed the economy into a severe recession. It took years for stability to return. Today, the global economy is even more interconnected and in many ways more fragile. The United States is now the world's largest oil producer. That fact often creates the impression that America is insulated from global oil shocks. But this assumption misunderstands how energy markets work. Oil is traded globally. Prices are set in international markets. When global benchmark prices such as Brent crude rise, American oil prices rise with them. Even if domestic production remains high, consumers still pay global market rates, which means a crisis in the Strait of Hormuz could still send gasoline prices soaring in the United States. And those price increases would ripple through the entire economy. There is another layer to this story, one that connects energy markets to the global financial system. Since the mid-20th century, most international oil trade has been conducted in US dollars. This system is sometimes referred to as the petrodollar system. Because countries around the world need oil, they also need dollars to purchase that oil. This creates a constant global demand for US currency. That demand has helped support the dollar's status as the world's dominant reserve currency. But that system depends on stability. If oil prices surge dramatically and the global energy system appears unstable, countries may begin searching for alternatives. Some nations have already explored trading energy in other currencies. China has experimented with yuan-denominated oil contracts. Russia has pursued de-dollarization strategies after sanctions. Even large importers like India have explored bilateral currency arrangements for energy trade. None of these shifts are dramatic on their own, but a major oil shock could accelerate them. For decades, global energy markets have operated on one crucial assumption: the Strait of Hormuz will remain open. This assumption has survived multiple crises. There were tanker attacks in the 1980s, regional conflicts, drone strikes on energy infrastructure, yet the shipping lanes remained operational. Over time, this created a sense of resilience. But resilience can sometimes be mistaken for luck, because the structure of the system has not changed. A significant portion of the world's energy supply still passes through the same narrow corridor. And as global demand for energy continues to grow, especially across Asia, that dependence remains. Return again to the Strait of Hormuz. Tankers continue to move slowly through its narrow waters. Millions of barrels of oil pass through each day. Refineries across the world depend on those shipments arriving on time. For the moment, the system works, but its stability depends on a delicate balance of geopolitics, economics, and security, a balance that has held for decades. The question is what happens if that balance is disturbed, not by a dramatic war, but by something far subtler: a rise in perceived risk, a spike in insurance costs, a handful of mines in the water. Because in global markets, perception can be as powerful as reality. And if that perception pushes oil prices toward $150 per barrel, the consequences would reach far beyond the Persian Gulf. They would ripple through global inflation, financial markets, and possibly even the future role of the US dollar. All because of a narrow corridor of water only 21 miles wide. A place where the modern world's energy system, and perhaps its financial system, passes every single day. And where the margin for error is much smaller than most people realize.